Hey everyone, welcome back to your weekly market outlook. This is for the 17th to the 21st of July 2023. Let's take a quick look at what's going on last week. A pretty intense week, I would say, for last week. We've got the US inflation number, and this is something that we want to focus on a little bit. The readings on the inflation number is actually below the consensus for all of them. We've got the monthly change at 0.2%, below the consensus of 0.3%. Monthly core inflation change, or the core CPI change, was 0.2%, below 0.3%, and a change from 0.4%. Headline inflation, we're looking at a huge drop here, again from 4% to 3%, a full percentage drop on the headline inflation. The core inflation also dropped significantly. This is below the consensus of 5%. We've got 4.8%. So if we take a look at all the readings here, it's all below the consensus. So we are looking at inflation cooling in the US. Now, I think the market has already priced in some of this, and if we take a look at the price movement over the past week, we saw the dollar kind of weakening. We've got risk appetite returning into the market here. This is again mostly driven by the drop in the US 10-year Treasury yields and also the rally in the stock market. But if we take a look at the movement in the currency side, I think we did get quite a push following the CPI numbers. We saw the US dollar weakening, and I think the focus was kind of lost a little bit in terms of the dollar pairs trade. I think a lot of people are actually kind of afraid to jump in on that rally following the CPI numbers. Number one, I think the market is taking a look at it. It's more of a grind to the upside, and it is starting to become a little bit overbought at this point in time. So I think from a technical standpoint, we should be looking at a potential correction happening in the market. But we've got the sentiment in the market. It's more like a euphoria last week with the inflation cooling off and the market expectation for the FOMC to hike one more time in July, and then they might pause. My opinion on this, I think there's still room for the FOMC to continue hiking in 2023. I think a September hike is very likely. So we've got July hike next week, and then we're still expecting a September hike. And I don't think it's quite over yet in terms of bringing the inflation down. If we take a look at the projected 2% from the FOMC, we're very close to that, right? The headline inflation is already at 3%. So next month with another percentage drop, we could actually reach that 2%. But then the attention would shift into the core inflation. Can the core inflation shift down to 2%? And also, we're not looking at the labor market really softening at this point in time. We did see a little bit of a drop this month for the NFP numbers, but it wasn't that big of a drop as of yet. So for the FOMC to actually stop hiking interest rates, I think they need to see the employment side softening a little bit, and the inflation continues to fall. I think those are kind of the two basic criteria for the FOMC to actually stop hiking interest rate. But if we take a look at the movement last week, I think it's clear that it's a dollar weakness. I'm just not sure for how long that dollar weakness is going to pertain following the market in the month of July. All right, so we've got the PPI numbers also below the consensus in terms of the gain. It is 0.1% versus 0.2%. Other than that, we've got the Bank of Canada hiking interest rate by 25 basis points. Not much coming out. We've got several news with the RBA, Governor Lowe stepping down. Vice governor is going to step in, but that's pretty much it for last week. I think the whole focus was really more on the CPI side of things. All right, so for this week, we're going to be taking a look at the RBA meeting minutes. We just got the Chinese GDP numbers. Again, it was higher than the previous month, but it's still below the consensus. It's coming in at 6.3%. So I think this affects oil a little bit more rather than anything else. And then we've got the RBA meeting minutes tomorrow. We've got the Canadian inflation numbers. We've got the US retail sales. And then on Wednesday, I think the focus would be on the UK inflation rate, or the UK CPI. Headline CPI is to drop from 8.7% to 8.2% for Wednesday. And then the attention is going to shift a lot more into what the Bank of Japan is going to do at the end of the month as well. So I think a lot of the driver last week was really more on the yen crosses as well, but both dollar pairs and the yen crosses are kind of really the market movers for the month of July. So on Thursday we've got the Japanese balance of trade. Focus would shift on Friday for the Japanese inflation rate as well as the UK retail sales number. Now for the Japanese inflation numbers, it is expected to go up again. Previously at 3.2%, we are expecting a 3.5%, but this is the national CPI numbers. I think a lot of the focus would come in more on the Bank of Japan inflation as well as the Tokyo CPI numbers. I think those two are driving the market a lot more. All right, so let's take a look at the technical side of things. So we can take a look at the dollar index here. We can see that drop there is a very significant drop. I think a lot of supports are taken out. We've got 101 taken out, 102 taken out, 100 was even taken out. So right now the index is actually currently below 100, but if we take a look at the current situation here, this is looking a little bit oversold at this point in time. So any recovery above 100 this week, we could anticipate a little bit of a recovery on the US dollar. So I think this is going to reflect onto the other dollar pairs as well. So the majors that we're going to be taking a look at, I think we are really concerned in terms of how far and how quick the price has gone in the past week. In terms of the momentum and everything else, I think we're looking at a severely overbought and oversold market at this point in time. So the dollar index is looking severely oversold at this point in time. We do anticipate a little bit of a correction before the dollar could continue to weaken, but we do anticipate a little bit of a correction to happen. How far of a correction are we anticipating for the dollar index? I think we're looking at a range between 101 to about 101.50. I think the maximum would come in at about 101.50. For the dollar to continue its downtrend, it would need to find that rejection to happen at about 101.50, but we'll see what happens this week. I think the market could calm down a little bit and start pricing in the potential for more rate hikes in the future from the FOMC. I think that's the only driver at this point in time that's kind of pressuring the US dollars, that the market is anticipating that with the inflation dropping off and cooling off like that, the FOMC needs to stop interest rate hikes. I don't think that is the case. I think the FOMC is still a little bit hawkish on that side. But yeah, we could see that sentiment shift leading up to the interest rate decision, which is next week. Okay. All right, next up is the Aussie USD. Several key levels to watch out for the Aussie USD. Definitely 69 cents is one. Beyond 69 cents, we're looking at 70 cents. And then support side, we're looking at 68 cents. Below 68 cents, we're not going to really focus a lot on the 67 cents, because if we take a look at the price movement, basically from March, we're looking at price really being more contained between 66 cents and 68 cents. So if there's any break below 68 cents, then we could potentially see a little bit of a correction in the market. The maximum support is really 66 cents. In terms of how far down it should correct, I think we should anticipate a little bit more of a correction towards 67.50. About 67 cents, we should potentially see a bounce happen if the market is to continue to the upside, right? Any close below 67 cents, that's going to put this in more of a sideways market condition with a much wider range between 66 cents to about 69 cents. So yeah, if we want to see the Aussie USD rally out further, we do anticipate a little bit of a pullback. I don't think 68 cents is going to cut it. I think we need to anticipate a little bit of a deeper pullback. A healthy pullback would be at about 67.50 to about 67 cents. Any bounces off from that, I think that's cue for for more long positions on the Aussie USD. Euro USD here, if we take a look at this one, sure, there's a little bit more room to go for the Euro USD, because in terms of Fibonacci extension, we're just surpassing 127.2. I think there's a little bit more room to go towards 1.13 if the market persists, and I think that's still okay. It is looking a little bit overbought at this point in time, but I think there's still room to go. So I'm not gonna be too surprised if the Euro USD continues to push and grind higher towards 1.13 this week before we see any rejection. That could happen for the Euro USD. Aussie USD a little bit more contained with the 69 cents. Pound USD, we need to be a little bit more careful with the pound USD. This one here is a very strong uptrend for the pound USD, but if we take a look at the grind for the pound USD, it has exceeded all Fibonacci extension, even with the flag that we noted at the beginning of July there on the breakout. I think This one here is a little bit overextended. It is beyond what can be measured with Fibonacci extension at this point in time. So we're really relying on key levels. We look at 1.32 as kind of a limit on the pound USD at this point in time. But if we see any pullback for the pound USD, the pullback is likely going to be kind of minimum. The maximum pullback anticipate for the pound USD is actually about 1.2850, which is the previous resistance level for the pound USD. Any pullback, any bounces off 1.29, I think that's already enough of a sign that mobiles are actually going to be in the market. I think the inflation number this week for the UK is going to be the key driver as well. I think the sentiment is going to shift depending on how the inflation is doing in the UK. If it cools off a lot more than what the market is expecting, then yeah, we might see a little bit of a deeper pullback for the UK, the sterling here. But if we see the inflation, being very sticky, being very persistent, and we're not meeting the consensus in terms of the drop, then I think that would be, a sign that the Bank of England still has a lot more in terms of potentially hiking interest rates in the future. So keep an eye out on sterling here. I'm not too comfortable going in for a long position. I still do want to go long on the pound USD, but I do anticipate that pullback to happen first. I think I need to see 1.29 and 1.2850 before making a decision whether or not to go long on the pound USD, really depending on momentum shift here on the pound USD. All right, lastly, we've got the Dow Japanese Yen. If we take a look at the Dow Japanese Yen, very close call on Friday last week. We got that drop below 138, but if we take a look at the daily close on Friday, we can see that turnaround around 138. Now 138 was the previous resistance on the Dow Japanese Yen. The move on Friday basically took that as a bounce from 138. It bounces off the Ishimoku cloud, bounces off previous resistance and support as well. And overall, if we take a look at this year, we still have a strong support trend line holding the Dow Japanese Yen. So I think with the Dow Japanese Yen, this one here is a little bit over in terms of the selling for the Dow Japanese Yen is a little bit extreme, right? We're looking at about 7.5 yen drop on the Dow Japanese Yen. It is very extreme in terms of how far it has gone down. It's basically 7 yen or 700 pips drop in just 1 week. So we got that selling because there's that anticipation for the Bank of Japan to actually tweak the YCC or the yield control curve. There are talks about the shift from 50 basis points to 100 basis points in terms of the YCC, or to completely take away the YCC itself. Now, this one here turns the market into more of a speculative market. That's number one. Number two, I think we're looking at a little bit of a short covering here for long-term carry trades positions. I think that's what's basically driving the yen stronger. And if we take a look at that, we're quite done there. There are several option expiries last week as well at about 141 and 139. So that's really capping the market from progressing any further. But we don't have any big option expiries going forward into July. So if we take a look at the Dow Japanese Yen this week, the bounces off 138. I think it's a good risk reward ratio if we aim for returns towards 145. Right, this could happen. And I think the key driver would be the Bank of Japan monetary decision, the monetary policy decision next Friday. If they don't change the YCC, if they didn't tweak that YCC, that's going to disappoint the market, and we're actually going to see the yen crashes. Right, when we see the yen crashes, we are likely going to see a return towards 145 for the Dow Japanese Yen. This again is also going to lift the Aussie Japanese Yen, the Swiss Yen, the Canadian Yen, the Euro Yen, as well as the Sterling Yen. So all of these yen crosses are still positively correlated to the Dow Japanese Yen. So if you're trading all the other yen crosses, I think the main drivers or any changes in the Japanese yen strength is likely going to be reflected on the Dow Japanese Yen. So keep an eye out on the Dow Japanese Yen. Personally, I still anticipate a return towards 145. I don't see the policy changes happening in Bank of Japan that quickly, and then the second reason would be that we saw the drop happening before the Bank of Japan decision itself. So we're looking at a scenario where, very similar to the CPI, is more on buying and selling the rumors, and then doing the opposite when the fact comes out, right? So the market could actually be setting itself up for a huge disappointment if the YCC didn't get tweaked by the Bank of Japan. That's going to to crush the Japanese yen. It's going to send the dollar Japanese yen and everything else, rocketing up in a very quick momentum as well. Now, if we also take a look at the divergence happening in the dollar Japanese yen, we're looking at a strong hidden bullish divergence for the dollar Japanese yen. Overall, the trend remains to the upside. I think this is a great buying opportunity for the dollar Japanese yen. Instead of looking for a short, I think we're looking at a very critical support level at 138. We saw that bounce off the Ichimoku cloud. It also bounces off 61.8% Fibonacci retracement. So there's a lot of technical reasons why we actually prefer to go long on the dollar Japanese yen. All right, so that's pretty much it for this week. Good luck with your trades. It's going to be a very volatile week, following that CPI. It's going to be more of a technical week going forwards to until next week when we get the FOMC interest rate decision. All right, see you soon.